Thank you very much, Sarah. Good morning, everybody. Welcome to this virtual meeting of the Pensions Committee on the 26th of June 2020. We've got all people present and we go through the apologies in a minute, but a special welcome before I read my announcing statement to James from Brunel and Chris from Brunel. We've also got Paul from Grant Thornton, Catherine from Scotland from Hymans, and we've got our usual representatives Kieran, John and Anakit as our advisors. So I have to read out this statement firstly. Before consideration of today's business, I will outline the protocols for the meeting. Today's meeting is being live streamed to the public via Microsoft Teams and is also being recorded. When members are speaking, they may choose to use their video, but we have been advised that for broadband width purposes, it'll be good if you could switch off your video and when you're not using it, and your microphone. When members are speaking, so they can use that facility, don't forget to put the microphone on, turn the microphone off when you finish, and I'll remind you if you don't. If the live stream should fail during the meeting and we can't share the proceedings, I will adjourn the meeting so that access can be restored. Stay logged on. If the issue cannot be resolved, I will then halt the meeting and remaining business be concluded at a future date. If a member experiences a technical issue, I'll join for a short period to try to re-establish their connection. And if a member continues to experience a technical issue, they have the number 01872 324498 to ring, 324498 to ring, which is get you straight through to a live technician. The vote will be taken using the raise your hands function, and Lynn, our Democratic Services Officer, will advise you of that at the time. When the press and public are excluded from the meeting for our part twos, members will be required in turn to confirm and declare there are no other persons present who are not entitled to either see or hear consideration of the matter. Where a member has declared a non-registrable interest, a disclosable pecuniary interest, or an interest by virtue of any trade union membership in a matter, they must leave the virtual meeting. Their departure will be confirmed and they'll be invited to rejoin at the appropriate time. Don't forget, members, and officers, if you wish to speak, please type an X in your chat box. We are reserving the hands up function just for the voting today. Before we start the business then, the Democratic Services Officer, Lynn, has got something to ask of all us members. Lynn?
Thank you, Chairman. Members and members of the committee, I'll now call your name. Members confirm your name and your electoral division, and can co-opted members please confirm your name and whether you represent employers or employees. So starting with the Chairman, Councillor Holly.
Derek Holly, Saltash East.
Could you please confirm? Thank you. Councillor French.
Councillor Tom French, St Austell Bay Division.
Thank you. Councillor Harris.
David Harris, Truro Trarhaven Division.
Thank you. Councillor James.
Sue James, Justin Penwith Division.
Thank you. Councillor Kenny, could you switch your microphone on, please?
Good morning. Good morning, and
Good
Joanna
morning.
Kenny, Newquay Pentire.
Thank you.
Chris,
Councillor Kirkham.
Good morning, Jane Kirkham, Cornwall Councillor for Falmouth Smithick.
Thank you. Councillor Mitchell, could you switch your microphone on, please?
Thank you. I have. It's Cornwall Councillor Pete Mitchell, St Agnes.
Thank you. Councillor Monk.
I, Councillor Monk, Yuki Treloghan.
Thank you. Councillor Wood.
Good morning, Councillor John Wood, Roach Division.
Thank you. And the co-optee, Chris Wilson, please.
Yeah, Chris Wilson, Employer Rep.
Thank you. I can confirm that the following local pension board members are also in attendance. Nigel Carr. I think it's just Nigel today. We don't have Mark Spilsby or Amanda Dole. Thank you. Thank you. Yes, Chairman.
Yeah, Ian Smart is here.
Thank you. Thank you. And the following officers are also in attendance. For Cornwall Council, we have Russell Ashman, the Head of Pensions, Treasury and Technical, and his pensions team are Matt Allen, Matthew Chapman, Matt Davies, Melissa Kelly, Calvin Matthews and Teresa Scroggie. The Democratic Services, it's myself, Lynn Beardsmore, and also Sarah Goodall, the meeting producer. External officers, we have the fund advisors, Annika Baduri of Mercer, Kieran Paul Dossett of Grant Thornton, John Finch, Independent. We have the fund auditor, Catherine McFadden of Hymans, and representatives from Brunel Pension Partnership, Chris Crozier and James Russell Stracy. Thank you, Chairman. That's the end of the roll call.
Thank you, Madam Secretary, for that. We'll kick off straight away. Apologies for absence, please, Madam Chairman, Madam Secretary.
Apologies for absence from Councillor Craigo, Nick Olgard and Andy.
Thank you. Are there any declarations of interest of any sort? Okay, there being no declarations of interest, I've got a 3B, but number 3 is the minutes of the meeting held on the 12th of March 2020. Could you indicate by raising your hand if you wish to propose or second the minutes? Joanna Kenny raises her hand to propose. Thank you. Could you put your hand down? Can I have a seconder, please? David Harris. Thank you, David, for seconding. Lynn, over to you.
Thank you, members of the Pensions Committee. Could you please raise your hand if you vote for the proposal to accept the minutes?
Keep your hands up, please.
At the moment, I'm some hands missing. Councillor Wood and
Choosing to abstain as I wasn't present at the meeting. Thank you.
Yeah, I'm
thank
in the
you.
same position. I wasn't at the meeting.
Thank you both.
Thank you.
The proposal to approve the minute 8 votes to 2.
Thank you. Is anyone against? Okay, and we've had the abstentions. Are there any more abstentions? Thank you. In that case, that's that. Can I just say that we've had some very useful questions sent in. Thank you from David and Andy, and you've all had a copy of those questions. So when it comes to that particular part of the meeting, we won't revisit those questions unless something new comes up relevant to that. So thank you for those people who are sending the questions in. But if you don't think the questions has been fully answered, then please feel free to raise it, David. Okay, thank you. In that case, on to item number 4, the Cornwall Pension Fund financial statements, pages 10 to 81. And So over to Sean and Paul. Sean.
Hi, thanks, Derek. Yeah, just before I give an overview of this year's accounts, I just wanted to give the committee a quick overview of the pack. So, as every year, the Pensions Committee is required to consider the year-end financial statements of the fund, and it's requested that the committee recommends the financial statements to the Audit Committee as part of approval for the Council's accounts. As part of the pack, the audit plan has also been included, which was scheduled to be taken to the April meeting, but that meeting was obviously cancelled due to COVID-19, so that's attached to the completeness. But there were no comments to the negative received on that. At the time of publication of the report, the 1920 management letter of representation wasn't available, so last year's has been attached as a reference for the committee, and as part of the recommendation, which you'll no doubt discuss later on, it's requested that delegated authority is given to the chair once the final version's been received from Grant Thornton. I'd just also like to note at this point that the annual report will be tabled at the September committee meeting. We do normally take it to this meeting, however, as the council's accounts aren't going to be approved until around October, it was felt that it would be useful to use the extra time to actually build in a responsible investment section for the annual report this year. So, I mean, that's not going to cause us any breach of deadlines because we don't have to publish the annual report until the 1st of December following the year-end financial statements. If I could just turn committee to page 17 of their packs, please. This page just gives the high-level figures. I mean, it's not included on this page, but I think the standout item that I just wanted to draw the committee's attention to is the impact of COVID on the financial statements. This has been covered in notes P5 and P6, and I will go into a little bit more detail later, but I sent out a track changes version of those statements yesterday following the audit findings, which was basically just moving some text from P6 into P5 and just slightly tightening the wording just to make it a bit more clear to the readers of the statement. What COVID's done on the accounts, which is drawn out in these statements, is in relation to the level 3 investment valuations. So these are the ones where there's a much higher degree of estimation required in these valuations. And what COVID-19 has done is it's given the valuers of these assets an unprecedented set of circumstances when trying to value these assets. So there's always a level of estimation uncertainty involved with the valuations of these assets, but I think we're trying to say that there's an even more unprecedented set of circumstances than usual. What the fund has done to attain assurance on these valuations is we've liaised with the fund managers of these assets, and from this work, the notes in the accounts highlight the risk of the values potentially being lower than that which is reported at the year-end date, which we've received. The estimate of that is between 0 and 27.9 million, and further detail behind those figures have been sent to committee following a request for more information. I mean, all I really wanted to say, unless there are any specific questions on the accounts, was really the fact that the only change which has been made from the version which was sent to committee and to the auditors is just in terms of those track changes statements which I referred to earlier, and there's been no further changes to them. So I didn't know whether anybody had any questions before I handed it over to Paul from Grant Thornton to just talk through the audit findings report.
And just to say that it is normal with level 3s to go largely on the opinion of the fund manager concerned anyway, isn't it? It's just more so now, if you like.
Yeah.
Yeah, thank you. So that's not unusual for that to happen. Yeah. Paul, over to you. Welcome again, Paul Dossett.
Sorry.
I've got a question from Jane Kirkham, please.
Thank you. Jane? Jane, are you there?
Hello. Yes, sorry, I am. I was just trying to turn on. I thank you for clarifying that, because I wondered about the level 3 valuations, and I noticed that the auditors had picked on that as well, and they're going to be looking at that in more depth. So that's brilliant. Thank you. There are just a couple of things. One of them is just, I think, probably my ignorance. On page 17, I was a bit confused about profit and loss on disposal of investments and changes in market value of investments, because obviously there's a big change between 2018-19 and 2019-20. And I just wanted to clarify, does that mean that the valuation of the investments has dropped, or does it mean we've had to sell some at a loss? How is that worked out? So that was my first question. And the other one was just about the management fees on page 53, because I saw that they had gone up. Obviously, it's been a more turbulent year, and I understand that the transaction fee has gone up, so there's obviously been more transactions. But I wondered, that extra 2 million, is that because of the extra transactions that there have been? Does that include the Brunel management fees as well? I just wanted a breakdown of where that extra 2 million had come from.
Thank you, Jane. Sean?
Yeah, okay. In terms of the first question, the profit and loss and disposable and changing market investments, I mean, really what that figure is, there's a more detailed table later on in the accounts in note P10, but what that figure is basically, it's like the balancing item, if you will. So largely it does capture the change in the valuation of the investments, and as you say, it also does capture any sales and the profit and loss from this, which is captured in that P10. But I mean, the bulk of the change this year really has just been due to the fall in market values. I mean, last year, as you can see from the table on page 17, there was a very significant increase in the market value of the investments, whereas as we're all quite aware, and we'll go on to that in more detail later, but you know, right at towards year end, the first quarter this year, there's been a significant drop in the value of the investment. So that's what that figure is capturing there in the main. In terms of the management fees, obviously I can't provide you the specific figures right now, but the large majority of that change from the previous year is in relation to the fact that the investments through almost all of last year were quite a lot higher than in 18-19. In 18-19, the average value of the fund was about 1.85 billion, whereas for 19-20, apart from the last couple of months of the year, the value of the investments was closer to 2.1 billion. So you know, you can imagine that we're charged a basis point fee on assets under management. So because that's higher, then you know that is obviously going to cause more fees when the values are higher. It does include the management fees of Brunel as well in that figure, just for completeness. And so yeah, so that's just to get it clear in my head. So that's, we're charged on a percentage basically. So that because the value went up, the percentage went up. Okay, thank you.
Thank you. On that one, on that same table, I circled the fact that performance fees had increased about 2 or 3 times. I think I've said this to you before, I'm just not a fan of fund managers who charge performance fees. I think they should do their job full stop. Is there a reason why it's sort of tripled?
Yeah, I mean, I will point out that the performance fees in terms of the overall fee level aren't particularly high. I mean, as I said, we had much better investment returns throughout the year, and that's what's caused.
That's different. That's okay.
Yeah, I mean, it's mainly due to the limited partners. I mean, the way their fees are structured is they get a certain fee up to a certain level, and then if they achieve quite a bit in excess of the performance targets set out, then anything on that, they then take a performance fee on it. It's just part of the standard private market pricing.
Yeah, okay. Just confirm that the application of performance fees is more widespread in the private markets, isn't it, than in other markets? Yeah, okay, thank you. Okay, are there any other questions? There's no other X's in the box. So in that case, we have a recommendation.
Oh, sorry, Derek, it's over to Paul for the audit findings report.
Oh, sorry, Paul. I'm so sorry, Paul. No. Stardom, and I've just passed you by. Thank you, Paul.
Thank you, Chairman. Yeah, obviously, members of the committee would have seen, as Sean referenced, the audit plan in the update, the audit plan and the plan update, which reflected the impact of COVID in terms of the audit approach. I'd just say, just in general terms, we're living in quite from an audit point of view, it's quite a regulated environment at the moment, heavily regulated, and the bar is being raised all the time. So we're required to, by the FRC, the regulators, to do audit with even more rigor than usual. And so that's reflected in our plan and in our approach. We received the accounts in a very timely manner. This is the first pension fund audit that has made substantial progress in Grant Thornton, and we audit a lot of local authority pension funds, so we're making good progress, I think. And the work we've done to date doesn't really identify any issues of significance I'd like to bring to your attention, so that's good. There's some work to complete, but it's been good progress so far. The only issue of that I would like to bring to your attention, and Sean, in a sense, referenced that in his presentation, was the issue about COVID-19 and estimation uncertainty on level 3 investments. And because of that, what we will be doing is, when we issue our audit opinion, we will be issuing what's called an emphasis of matter. An emphasis of matter is not a qualification. It is just a thing the auditor wishes to bring to the attention of readers in terms of the context of the audit. And what will be, you could only issue an emphasis of matter if there's something disclosed in the accounts that you want to emphasise, obviously. And what Sean talked about in terms of what's been updated in P5 is what we will be emphasising, which is effectively the pension fund's disclosures about the uncertainty on level 3 investments. So this will be something we'll be doing across all of our local government pension funds. It's not particular to the Cornwall fund, but that's probably the most significant issue I would probably bring to your attention at this stage. Obviously, it's not something we normally do, but I mean, obviously, as we're all fully aware, this is a incredibly unusual set of circumstances, and therefore, just bring that to your attention. And obviously, happy to take any questions that members have got.
Thank you, Paul. I can't ever remember us having an emphasis of matter. Perhaps it's just passed me by in the past, but I don't think we have.
Probably not, no.
Okay, thank you. Thank you. David Harris, we have a question, David.
Question from David Harris.
Sorry, I'm there. Yeah, within your audit report, you make the point, as part of the Cornwall Council audit, we've identified IT internal control weaknesses, which also impact the pension fund. Can you just comment a bit more on that, please?
Yeah, well, I think we've identified some sort of IT control, detailed IT control problems that we have sort of flagged up to the council, and obviously we're talking about the pension fund using the same system, obviously. These are matters that we consider to be weaknesses, not necessarily weaknesses that impact on our opinion, but sort of control weaknesses in the operation of the system. So I don't have the complete detail to hand, but I can provide that to committee members if they'd like. But it's just something we wanted to flag up because these are messages we've raised with the council before. But I can provide the committee with more detail on that if needed.
It would be useful. And so, can I just comment, Chair, on this emphasis of matter point?
Yeah.
I've been reviewing this on a company way away from Cornwall, and it's an absolutely reasonable comment to put in. You know, I've gone into great detail, interestingly, with GT on a quite different company and one of their senior technical guys, and it absolutely makes sense to put it in.
Okay, thank you. Thank you for that.
I got a question, Paul, got a question from Jane Kirkham, please.
Jane?
Sorry, I was actually going to ask about the IT weaknesses as well, because I've picked up on that. So thank you for doing that. And yes, it would be nice to have some more detail about that, because we've heard other things about that elsewhere. And I was going to ask a bit again about the level 3, and I was going to ask, I understand the emphasis of matter paragraph, and that makes perfect sense in the current climate, obviously. But because as I said earlier, I looked at the fees and they were an extra £3,000. For that £3,000, I mean, I know you're still partway through the work in valuing the level 3 investments at the moment. How do you actually do that, apart from it says here, rely on the fund managers, rely on the custodian, and testing the valuation by reperforming the basis and review any assumptions? So are those the two things that you have to do now, kind of the recalculations?
Yes, that's right. Yes, and that's obviously always in the context of the emphasis of the matter, but nevertheless we need to go through that in detail, because it's one of the areas that our regulators say that auditors need to do more work on. Test the assumptions, test the reports are up to date, go through that in some detail, do some sensitivity analysis, do some comparison between funds in different parts of the different pension funds, and just demonstrate that the figure presented is robust and supportable, and that's what we'll be doing in some detail. And one of the things we have to consider, actually, and we have been considering it in terms of Cornwall, is whether or not we need to engage our own experts to look at the level 3 investments. Our current view, based on my discussions with the team and our review of your investments, is that because of the amount of information we've been provided with and the support to that, we're currently not minded to engage an expert. We would probably do so if we couldn't understand or couldn't substantiate some of the judgments, but we made a positive start on that in terms of the Cornwall pension fund. So at the moment we're not minded to engage experts, but that is something we ultimately have to consider. There are some funds for example own direct property, where we're already engaging experts to look at, because it's very complicated. The level of private equity, the level of infrastructure funds, the scale of that, the materiality of that, are the sort of things that drive us towards engaging experts. So there's a lot of work to do on level 3, I think it's fair to say.
Yeah. Thanks very much.
Thank you for that.
Okay, Jane.
Thank you very much. Yes.
Mr. Chairman, Russell Ashman would like to ask a question, please.
Russell.
Thank you, Chair. I was just going to come in on the system issue, with a sort of Cornwall Council perspective on that. This has been flagged for a couple of years with the Cornwall Council existing Oracle system on premise. One of the reasons it hasn't been addressed during the last 12 months is that the investment needed to do so was not deemed to be value for money, with the fact that the system was changing this April. So although we were aware of the weakness, it wasn't corrected. It wasn't deemed to be a serious enough weakness. I think it is an amber, it isn't a red. So it was just a matter of, we will have to let it run for 12 months and we will address it going into the new system. Thank you.
Thank you, Russell. Okay, there being no other questions, Peter, is that right?
No more.
Thank you. In that case, we have a recommendation on page 10, which is that we recommend the financial statements to the audit committee for approval, noting the findings, and thank you, Paul, again for that, and that delegated authority be given to me to sign the letter when it comes from Grant Thornton. So will someone move that, please?
So, Chair, can I just interrupt before you move the recommendation? I did get an X in the box. Yeah. Sorry, I've got to tell you, I am incredibly unhappy with the idea of the committee approving a letter of rep unsigned. I've no doubt whatsoever you will read it properly, but it goes against everything I've done throughout my career to approve, to let somebody sign a letter of rep on my behalf without my seeing it. And I wonder whether you could change that recommendation to say something like that, subject to its previously being circulated to members for review and comment, authority is given to the chair.
Sean, can you comment on that, please?
Yeah, I think that's a sensible recommendation. I'm happy with that.
Yeah, can you reword that then, if the other members are happy with it, which I certainly am. What did you say again, David? That
comma, subject to its previously being circulated to members for review and comment, delegated authority, etc.
Okay, I just put subject to its previous review by members, okay? Is that all right?
Well, yeah, whatever, yeah.
Okay, in that case, in 2, Lynn, there reads that delegated authority is given to the Chair of Pensions Committee, subject to its previous review by members, to sign the letter of representation on behalf of the Pensions Committee. So it's got the word subject to its previous review by members, Lynn, is that okay?
That's fine, Chairman, thank you.
Thank you. In that case, could we have a proposer, please? David proposes, and a seconder, please.
We've got James second.
James seconds. Lynn, can you pass over to you, please?
Thank you. Everybody in favour, could they please show?
Raise your hands. Someone's chair's creaking badly. Turn your microphone off, please.
That's the,
Unless it's
my
knees,
table,
Derek.
sorry. That is unanimous. Thank you.
Thank you very much indeed for that. In which case we move smoothly on to item number 5 on page 82 to 96, which is the cessation policy. And Kelvin, can you take us through that, please?
Yeah, certainly, Chairman. This is basically a statutory change. The regulations for the LGPS were changed in March. I would say primarily at the request of most of the LGPS pension funds. The regulations originally changed in 2018, whereby for the first time, if an employer exited the pension fund and there was a funding surplus, it gave us, well, it told us that we had to refund the surplus to that exiting employer. This subsequently caused some considerable problems for some pension funds, not us, I might add, where contractors were deliberately ending the contract to get their hands on the surplus that existed in the pension fund. The government, for a change, took notice of what administrating authorities were saying, and in March they changed the regulations again, which basically gave a discretion to the pension fund to determine how any funding surplus that existed when an employer left the scheme could be either distributed back to the exiting employer or it could be left in the pension fund. Because it's a statutory change, I've amended our policy to take account of this. Hymans have reviewed the changes that I've made and are quite happy with it. I've also amended the interest rate on in section 6 on page 92, whereby if an employer exits the scheme and there's a deficit and they cannot afford to pay off in one go, they want to spread the payments over a period of time. And in line with the previous policy, I've increased the rate of interest we would charge to spread that payment from 3.9 to 4.1%, which is the current expected return on the assets of the pension fund. I've also taken the opportunity to extend or expand the section 4.2 on page 89 to better explain how we deal with academies who are constantly merging with each other, because that's the most frequent cessations that we have within our pension fund. Finally, the government have given either the exiting employer or the scheme employer that admitted the contractor in the first place to the fund the ability to appeal any decision that we make with regard to paying out any exit credit to the pensions ombudsman if they're not happy with what we've decided on how to pay it out. So there is an independent party who can review what we do if either party are not happy with what we decide on how to distribute any funding surplus when employer exits the scheme. As say the policy is in Appendix 1, pages 87 to 96. The main changes to take account of the new regulations are shown in Section 7, which starts on page 93. Thank you, Chairman. I'll take any questions now.
Thank you. So essentially, it's to our benefit, these changes, that makes things fairer for us and the other employers in the scheme.
It does indeed, yeah. Kind of the government went from one extreme to the other, because pre-18, if there was a surplus, we kept it. If there was a deficit, the exiting employer had to pay it. They then went to the complete other extreme and said, well, if it's a surplus, you must pay it out. They've now reached a kind of a happy midway point, which allows us to consider various things before we finally decide how we pay out any funding surplus. Of course, that's if there is a surplus when an employer exits the fund.
Okay, thank you. And just to double check, Catherine, are you there? Could you just confirm that you're okay with all this?
Yes, thank you. Yes, we've read the policy, as Calvin says, and we are okay with it. Just a note that, as Calvin said before, it was very black and white. Both previous sets of regulations where you either you don't pay out the surplus, or and then we moved to the very strict you do pay out the surplus. The kind of halfway house we find ourselves in now is it's effectively at the fund's discretion to pay out the surplus, which is probably a good position, but does leave, as Calvin noted, there is a process of appeal to the Ombudsman, and the fund will have to exercise this discretion, as it does all its discretions, with care, because we've already seen some employers contesting these decisions. So yeah, it's good to have the policy, and I know Calvin and the team will.
I think it's very opposite time as well, with the possibility of some employers not being there in a short while. Okay, thank you very much for that.
Can I ask a question, Chair, please?
Yes, Pete.
Calvin, I noticed you're putting it up from 3.9 to 4.1 because that's the current percentage if somebody reneges on the scheme. Could that not be written in that is always the case, rather than you having to do that every time? So that written in that that they would pay back at the going rate at that time.
I could, Peter, but normally we only review this rate every 3 years, and I think it would be more specific for an employer to be able to review our policy and know exactly what the percentage rate is. Otherwise, they'd have to continually contact us to find out what the current rate is. If the rate changed on a more frequent basis, then yes, I would agree. But I would prefer if you're happy to keep a specific rate in there, which makes the policy more open, so they can see what the actual rate is.
Yeah. Okay. Thanks for that, Calvin.
Thank you for that. There being no other questions, will someone move the recommendation on page 82, please, which is approval of the cessation policy? Sue proposes it. A seconder, please. And Oliver, thank you, Ollie, for seconding it. Lynn?
Okay, could everybody in favour please raise their hand? That is unanimous, Chairman. Thank you.
Thank you, Lynn, very much indeed. In which case we move on to the next item, which is item number 6, Cornwall Pension Fund Business Update. This is part 1 note, page 97, if you're not on there already. And Russell will be leading on this, passing over to Anakit and Kieran at some point, and at the end, Sean wants to talk about the responsible investments. So, Russell, please.
Yeah, thank you, Chair. If I move you on to page 102, what we've got in this report is we have the performance for the last 2 quarters, the quarter ending 31st of December 2019 and the quarter ending March 2020. We're doing this because obviously the December quarter end we were going to bring to the April meeting. Although we have shared it with members informally, we're bringing it to committee so that it is formally presented today. So quickly, if I just go through the December position, you can see there that at the end of December, the investments were worth just over £2 billion, nearly £2.1 billion. That is slightly down on the position as at the end of September. We were down 50 million, which is equivalent to 2.3%. But quite importantly, if you look at the right-hand table, we're up quite considerably for the year to date. We're up by 8.2%. So from the valuation date at the end of March, as at the end of December, and we'll get to the next quarter in a minute, we were well ahead of that position at the valuation and well en route to meeting the target we'd set for the year. Liabilities moved slightly between September and December. They went up to just 2.1 billion, very small 0.6% change. And actually they're down slightly over the year to date, down by 24 million or 1.1%. The net impact of all this is that as at the end of December, the fund had a small or smallish deficit of £26 million. When I say small, if you compare that with the position as at March, the beginning of the year, which was 207 million, it has come down quite considerably. That's equivalent to a 98.8% funding position, albeit we were slightly in surplus when we reported at the end of September that quarter, but it's still a very good position at the end of December, and the fund looking very healthy. So I touched on the December because we hadn't reported it previously. Now if we start to move on down through the report, again, just for completeness, bringing your attention to the fact that Newton have a holding over 20%, and we have to do that based on the government regulations. I'm not going to dwell too much on the market update because that period is a significant time ago now, and obviously we've had a lot of activity since. The performance summary again set out on page 104, it's there for your information. That is the performance by manager as at the end of December. Again, I'm not going to dwell on that because it is quite historic. And then I'm moving on to page 100 and I'll get there in a minute. 106, and probably to say is that the position at the end of December I've just gone through. So then we move into the quarter ending the 31st of March. I think it's probably a quarter that we won't forget. Put that quite simply. If we started the quarter with a lot of noise and a lot of movement in the market due to Brexit, which we've almost forgotten about now. The China-US trade war was still continuing and escalating during the period. We had an oil price war which between Saudi Arabia and Russia, which gave rise to unseen oil prices, and actually on the futures market they were actually negative for a period of time. And then on top of all that, as we know, we had then in March the COVID-19 position, which caused obviously significant issues in the market. I mean, it obviously contributed to very poor GDP figures for the quarter. We had emergency interest rate cuts in the UK and elsewhere in global economies in the world. Quantitative easing reappeared, significant amount of quantitative easing in the UK. There was extreme volatility in the currency markets, particularly around sterling. fiscal stimulus packages started being implemented by various governments throughout the world, and generally in those last couple of weeks of March there was a real market panic, I think, as you could say, within the various markets where assets were sold down very quickly. Obviously that impacted value, and people moved to cash. Cash became the asset of choice for a short period, and when I say cash, it was real cash in many instances. The old idea that gilts and bonds were actually safe and were a proxy for cash, even those were sold down dramatically, and real cash is what people went for. The impact of that was that although central banks had reduced the interest rates quite significantly, actual market rates for a couple of weeks were quite higher than we'd seen for some time, due to the fact that all of a sudden there was a bit of a cash shortage. But then the quantitative easing kicked in, and things began to settle down. So overall, with a quarter which we won't forget, how did that affect the fund? Well, set out there on page 106, you can see that our investments went down by £173 million for the period, which is equivalent to an 8.3% reduction. Interestingly, though, if you look across to the right-hand table, it isn't that far different from the position as at the beginning of the financial year when the formal valuation was done. It is only down by about 16 million, or 0.8% from the position as at the 1st of April. So basically what we've done in the last quarter of the year is lost all the upside that we've earned in the first 9 months of the year. In terms of liabilities actually went down slightly in March to just over 2 billion, down by 105 million from the December position, and that was equivalent to a 5%. And they're down over the year to date as well by 129 million. So what does that give us in terms of the overall position of the fund? Actually, the position as at the end of March is that we've got a deficit of 94 million. Okay, a bit disappointing because we were very close in December of being balanced, and actually in September, the quarter before, we were slightly in surplus. But that's still a significantly better position than we started the year, where we were 207 million in deficits. So that's equivalent to a 95.3% funding position. And I say that's up 5% on the year to date, albeit it's down 3.5% compared with the December. So it's a poor quarter. It has put us back to where we were really at the beginning of the financial year, but probably surprisingly to some people, it's not quite as drastic reduction as people would have expected. And probably also to add in here at the moment is that pretty much hot off the press from Sean and the team, I'll just get the figures that I've jotted down here, is that as at the end of May, another couple of months on, the value of the assets now have risen back from that position of 1.91 at the end of March. They're back just under 2.1 billion again. So we're very, very close to the same position at the end of December as at the end of May. So a lot of that loss in the first quarter of this calendar year, our last quarter of our financial year, has been recovered in the first 2 months of the new financial year. I caveat that with that's the position today. Obviously, we all know there's volatility in the market. People are expecting maybe another drop in market values at some point, but that is the position as we speak today. And it's interesting that actually the Newton Fund in early June is now up higher than it's ever been, at over £500 million. So although a crisis in those last 2 weeks in March, we've weathered it reasonably well, as you can see at the end of March, although disappointingly down from where we had got to. But a significant recovery in the first 2 months of the year. And again, just mentioning there that the investment's over 20%, that Newton, again, by the regulation. I just have to draw members' attention to that. I think I will just comment that the other activity during the period is that we've continued to transition assets to Brunel. So work hasn't stopped, hasn't ceased. We have transitioned more assets into Brunel, and we've started selling down the frontier market holding with HSBC, where we sold a significant proportion of that recently. So we've continued doing the activity that we plan to do. At this point, I think it may be apt, rather than run through the market update that's presented in the paper here, which I've covered mainly because it is very COVID related, but hand over here to Kieran and Annika from Mercers to give their view on what they think the market is going to do from now on.
Mr. Chairman, can I get a question from Joanna Kenny, probably for Russell?
Before you do, Joanna, can I just ask either you, Russell, or Kieran and Annika to just remind members what protection we've got and how it may help us in the future? Okay, the sort of levels of protection and the types, will you? Thank you. Joanna?
Thank you. It's more a comment than a question, really, because I remember we had this debate at our last meeting and we decided whether we were brilliant or lucky. And I did think you were going to say that we're unlucky this quarter, so I am actually quite stunned by that 95.3% result. I think it is amazingly skillful. Perhaps what I'm really interested in, how are sort of other pension funds managing? Do we have any peer information about how they're doing? And maybe the next speakers will be able to tell us.
In that case,
yeah, absolutely. Well, if I start on that, perhaps then I'll hand it over to Annika to give it the current market conditions and talk about why the fund has been so resilient in a way. While on, a -8% loss in the quarter is never welcome, when you compare it, as Russell said, with equities alone, which were down at best 20% if you took a global equities comparison, or 25% in UK terms. We're pleased, and for some years we've advocated the lower equity weight this fund has had and said we shouldn't go chasing a higher weight in equities just because equities continue to do well. We need to think about the resilience for the medium and longer term. Shorter term, we have the tactical portfolio, but I'll leave that to Annika, and I'll also leave him to give us an update in respect to the risk management framework, which again is now effectively in play, which is a welcome position. Just quickly on other funds, it's a very mixed picture across the LGPS. So we consult across a range of funds from the London Borough market through to the bigger counties, all up and down the UK, and the funds that have had what I would call a high weight in equities took a big hit at the end of March, but I've obviously seen a significant recovery. So you just take the US equity market, it's had significant strength subsequent to the downturn of 24th of March, but so have other regions. Where we're waiting to see on that, I'll leave it to Annika, but those funds that took an initial hit and had a high weight in equities have seen a good recovery, so the picture for them is still somewhat good. I think there's been an increasing focus with those funds who haven't had risk management embedded to think about what they need to do for the future, because it was such a shock what happened, and it was a left tail event times, I don't know how many you wish to times it by, because we had the oil price move, which was a generational shift, albeit it was fairly temporary. We had clearly COVID-19, which has not gone away, as you can see with the rising rates, particularly across the US, and then we had government intervention as well as central banks. So risk management, I think, has come back on the radar of a number of funds. I think that the one aspect that all funds in the LGPS are grasping with in the background and heavily reliant on data, which is still coming through and will really only come through probably around July, August, September, is the private markets allocations. So if you take your illiquid allocations that you have in the funds, whether or not they're managed by Brunel or directly with managers, a lot of the data regarding things like private equity positioning is still coming through. So that leads itself to two questions. The first is, has it in due course given you an illiquidity premium through this crisis or not? And second, what are the opportunities in private markets going forward? So we do a lot of work looking at the markets themselves, but what we would say is key, and I think we put this out in the note responding to questions from Andy, manager selection in private markets is vital. So whether you can pick an asset class like equities and go passive or active, and people have their own views there, manager selection will potentially have benefit or not, but in private markets it can have significant benefit. The differentials on the statistics of, say, better performing private equity managers versus the lower quartile managers, for example, is significant. So what we're seeking going forward is the opportunities in the market strategically, but we're also looking to have the manager selection piece delivered, which, you know, effectively will be delivered by Brunel as you go further and further into Brunel for private markets. So I'll summarise and say that equity weights have been considered with a view to risk management. Private markets remain particularly interesting, but also an area of lack of data at the moment. There's not a comparable lack of data across the LGPS yet to see where those private markets valuations lie, and they'll come through later in the year, as Grant Thornton have probably already commented on. So really they're the kind of diverse positions. Probably the only other aspect that is relevant for Cornwall is your credit strategy with Insight. There's again a big focus on the credit market. Sanika will talk more about it, but we have a portfolio structure that will allow us to dip in and out based on Insight's asset allocation views into credit, and the movement in credit spreads since March to date, and particularly in sub-investment grade credit markets, has been very, very interesting, but also opportunistic. So maybe at that point, unless there's any direct questions on LGPS,
yeah,
I'll hand it to Annika.
Sorry, Mr. Chairman, I've got a question from Sue James.
Sue, thank you, Peter. Sue.
Okay, and this may be an unanswerable question, and I'll leave it there, and Annika will be able to decide whether he can include it in his response. You probably won't be surprised to know that my interest in terms of resilience is whether, you know, had we divested more from fossil fuels, lower carbon, would that have made us more resilient, or is there evidence that you know, the progress we've made has made us less resilient? You know, obviously I hope something, and it isn't, because it's nice if something that ethically you believe in is also good financially. So it's whether there's any indications on that front, because it would be really nice if the stars aligned and ethics and money somehow came together. So I'm not expecting a precise answer, but if Annika can build that into his response, that would be brilliant.
I want a precise answer. Before Annika starts, can I just quickly come in for Annika can respond and give the update. Just a reminder that there's quite an extensive report on the risk management framework in part 2 of the meeting, so probably save the detail until we get to that. Okay, thank you.
Yeah. Sorry, Mr. Chairman, I've got another question from Jane Kirkham, please.
Sorry, I've just heard what Russell said. It might be wise for me to say this. I was going to ask some specific questions about the Insight, and also about my obsession, which is the hedge funds. But maybe I should leave that till later, until we're in part 2.
Happy to answer in part 2, Jane. Absolutely.
Okay, Annika, say what you can now, will you?
Yeah, so I will leave some of the responses on the various portfolios for part 2, including the risk management framework, which, as Russell mentioned, we have just implemented it this week. In terms of answering Sue's question, I do not have any direct comparison, but Sue, in terms of comparing the broader equity markets, if we were to look at ESG index compared to the broad index, then the ESG index has outperformed the broad index, and that kind of gives you some indication of in broader equity market structure whether ESG is adding value, and hence you would see a lot of market participants, including in the training man groups, talked about ESG being a factor, and that is being looked into in the industry for some time now. The two other things that I wanted to mention very quickly that Derek asked was the various shapes of recovery that we have been thinking about, and I should emphasize very beginning that there is a disconnect between economic recovery versus financial market recovery. And there could be several reasons for that. For example, we have already discussed financial markets recovering very, very quickly over the last 2 months. And that could be because if we look at it very mathematically, then equity valuations is the present value of very, very long-term earnings, say 30 years earnings. So even if there's 1 or 2 years of lower earnings, that should not, again, mathematically have a huge deviation in their pricing that we witnessed in Q1. The other thing is the impact of tech stocks, as we call it, the FANG stocks: Facebook, Amazon, Netflix, Google, and Apple. And right now, the FANG stocks in the overall S&P 500 index weighs about 20%. So if, as you know, that there has been an over-reliance on technology over the last few months, and those stocks have moved by 50 to 60%, depending on which stocks we are talking about. Apple is more than 60% from its lows. And the 20% weight has actually driven the broader market up. So two ways we look at financial markets. One is what the optimists are thinking and what the pessimists are thinking. And there are indices that you can see in terms of optimists and pessimists. To give you an example, if you look at leisure stocks or cyclicals, then that could be an optimist, or retail indices, then that can be how optimists are thinking. And you will see that a lot of those retail indices have bounced back, and it is close to its previous levels at the start of the year. But again, if you look at pessimist stocks, for example, airline stocks, then those are down 40%, and they haven't recovered at all. And we know the reasons, but that kind of shows how market optimism and pessimism works. And right now, broader optimism is working in the broader market, and therefore S&P 500 is up almost 40 to 45%, and so is many global markets. But coming back to what economic recoveries would or the shapes of economic recovery could look like. Now, there are two or three different shapes that has been quite widely discussed. One is, of course, the V shape, and it's almost an extrapolation of the market events now, that lockdowns will be a few months of social distancing, and they would be returning to normal in Q4. 2021 is going to look good, and therefore economies are going to bounce back on the back of significant monetary and fiscal stimulus. And effectively, that is the entire thesis behind a V-shaped recovery of the economy in line with markets. But there are two others which is quite extensively being discussed. One is W-shape, and effectively it means that so markets will bounce back, or economies will bounce back, but during autumn or winter there would be a second wave, or industries would start failing because a lot of the behavioral impact is going to start making some of the industries quite redundant, and that would effectively bring in the second round of fall in the economic recovery. And therefore, in spite of monetary stimulus continuing and that not stopping, there would be another fall before there is a rise. But between the V and the W, there is a third, which, in terms of the shapes or the alphabets that we have discussed in the paper that we had shared with you earlier, we talked about a U or a L, and you can understand from the U or L what it means. It means just a slow, gradual rise towards normal. But right now, as market participants keep talking about new things, there's a Nike swoosh that's being called. So effectively the shape of the Nike symbol. So again, reflecting the L and U, wherein there will be, in spite of the monetary and fiscal stimulus, there would be a lot of failures, there would be a lot of behavioral changes, and therefore there would be not immediate in 2021, but in 2-3 years time or longer, markets will slowly or gradually start increasing. And there has been discussions about whether it's deflationary or we are looking at it as a recession or a depression. And some participants say if it is a recession, a W shape or a V shape is possible, but if it's a depression, then it is more of a swoosh. So again, we don't know all the details. We don't know whether there would be a second wave or what the impact of second wave is. One view again of second wave is that markets don't like uncertainty and economies don't like uncertainty. So the first wave was quite uncertain and rapid. The second one isn't. So there is a lot of tracking going on, and therefore there would probably be greater preparation even if there is a second wave. And that is another wave. That is another view that can effectively, is not a therefore a case for the swoosh, but more a case for a W. But it appears as our base case scenario that 2021 will not be a full recovery. The full recovery will be even at best in 2022.
Thank you, Annika. Just think, Annika, before you leave, can I just ask you a couple of questions? First of all, it's a sort of general question. If you look around the world, and I think Kieran said, I mean, the game is who can print the most money. Especially if you find a country that's not printing money at the moment. So, I mean, in normal times, if everyone printed money like this, you'd expect inflation after a while, wouldn't you? Is that going to happen?
There is massive debate about inflation. The way we have been talking about monetary policies, we kind of looked at over the last 10 years, 3 waves, and it's almost M1, M2, and M3 as well, how we have been looking at it. M1 being interest rates falling. So when interest rates moved from, credit crisis times at around 5% to close to 0 now, and that was effectively putting more money in the system. But that did not have much effect. We did not see inflation coming through. The next was quantitative easing. And central banks tried to put money through asset owners, through banks into the system. Again, a lot of that money went into either share buybacks and various other corporate activity, but did not again go down to the system in general. And now, therefore, we are talking about M3, which is the government is borrowing and the central bank is funding, which we have discussed earlier, modern monetary theory, and effectively that is to put money back into the system so that every dollar or every pound works better, and a lot of it is through infrastructure spending. And that is in the longer term, in the medium term, inflationary in nature, because people will, in case they have money in hand, then they would spend. But we think that right now inflation is looking very, very cheap. When we look at it from an asset perspective or even from a hedging perspective, buying inflation looks very cheap, but it's about timing. Is there a disinflationary scenario first before inflation picks up? But when you look at a 10-year inflation at this point, it looks much lower than any of the central bank targets, and we don't believe that it's going to be inflation will come back essentially unless we are talking about Japanification.
Okay, yes, indeed, we don't want that. Okay, thank you very much. Have we got any other questions? Sue, is that a question you had there? Or just a comment?
I'm taking it as a comment,
just
Mr.
Chairman. Just showing how old I am.
It's just for the very
no more questions.
No more questions. Okay, thank you very much for that. In case if there are no other questions, everyone. Okay, we have a recommendation on
Derek.
Yep.
Sean wants to come in on.
Oh, Sean, I'm so sorry. I forgot the RI bit again. Thank you, Sean. Please go on.
That's all right. Yeah, it's only a quick one. If I could just turn the committee to page 116, please. You'll find a link there to the first annual outcomes report, which has been published by Brunel in conjunction with the funds. And there's a lot of work went into this, and I think the report really reiterates the commitment of the partnership in terms of responsible investment. The report goes into some of the annual performance on issues such as climate change, tax transparency, diversity, supply chains, and quite a lot of other quite in-depth information and achievements on the partnership. I think one of the important things to note for me in the report is that we achieved the target set to reduce the carbon intensity by at least 7% over the year in all the active equity portfolios. That was one of the targets which we set out in our responsible investment strategy. So it's good to see that already the first year on, that's been met. And I think the only plea I'd have is if anybody's got any feedback on the report, if there's anything people would like to see added into it, or any further explanations on any of the topics to be added in, it would be useful if you could feed those back to me, please, because we've got a responsible investment subgroup meeting next month where we're going to be looking at the template for next year's report, because you need to start these things really far ahead. And that was it, really. That was all I wanted to say. Thanks, Derek.
Okay, thank you very much. Are there any questions on that? I don't think there are. Okay. No.
Questions, Mr. Chairman.
Thank you very much. Page 97, we have the two recommendations. One is noting the fund's position and noting the performance of the investments as in appendices 1 and 2. Someone please move that. Thank you. Ollie, was that Oliver moved it? Did I have a second? Or I missed that. Pete, you seconding it. Thank you very much indeed. So, Lynn, please.
Thank you, Chairman. Just going through now. I have 9 votes in favour, Chairman.
Okay. Does that mean we have someone not voted?
Any against? Are there any against? Could everybody please, if there's any against, could they please show? Chris Wilson, I have your hand still up. Are you against the recommendation? Thank you.
Sorry, I've got
None against, Chair. No votes against, Chairman.
Okay, thank you very much indeed. In that case, we'll proceed to the next item, which is item number 7, administration. And Calvin?
Yeah, thanks, Chairman. Pleased to say there's nothing to really worry about in this report. On page 149, we've had very small numbers of changes to employers in the fund. No new employers in the fund at the moment. We've had one local charity leave the scheme because their last active member left the employment there, so that's a natural end to membership of the scheme. On page 150, I'm pleased to report we're still getting more posts join the scheme than leave, so that means that the active membership is still slightly going up. On page 151, I've added a new table at the bottom of page 151 because I've been reporting on a number of cases that we complete in the office, but I've had 1 or 2 queries on the number of outstanding cases. So I've now added a new table, which you can see on the bottom of page 151, which shows the number of pending cases that we've got. So this is the amount of outstanding workload that the office is currently facing at the end of March. Now, some of these, like the refunds and the retirements, have gone up quite a lot in the 3-month period. That's primarily to do with where we've processed some calcs, but we're still waiting for the members to come back and fill out the refund form to say they want the refund and where to pay it to. And certainly for the retirements is where we've written to the members with their retirement options as to do they want to commute pension for cash, and if they're paying any extra, how they want that to be used. So a lot of those cases are where we've done some work, but we're still waiting for the member to come back and tell us how they wish to take the benefits from the pension scheme. On page 153 is the normal death grants. Again, we've paid out, which is a pretty standard figure for a quarter, just over half £500,000. I'm pleased to report this time most of those were paid in accordance with the expression of wish form that we had on file, which make your job and my job, Chairman, a lot easier. The main issue I think we've had is with the Oracle system. You can see that I've listed all the problems that the team has had with the new payroll system coming online. I think most of this could have been avoided if we were given the option to parallel run the new Oracle system with the old ERP system, where it would have created some more work for us because we were inputting on two different systems, but a lot of these problems would have been sorted prior to us going live. We received some training, but it was, in my opinion, too little, too late. As you can see, there were a number of 69 pensioners that should have been paid in April, but they never got paid until May because we couldn't get access to the system to get the new pensioners on. But I'm glad to say that's all been sorted. So they were all paid in May. But again, that created some more work for the team because then we had to calculate the arrears they were owed for April. And also, of course, in April, it was the annual pension increase that we had to apply to pensioners. So that kind of created some even more work for us. I'm pleased to say it has settled down. We've had some extra training. The team appear to be getting things done a lot quicker now. So it has settled down. Pensioners are being paid, which is the main point. But it's been very challenging times for the team over April and May, and thanks to a lot of very long working hours, we've managed to keep the pensioners paid. Going further onto that, with the COVID-19 coming on to us, most of the team have been working at home. Some of them for the very first time. We have maintained a smallish presence in County Hall. We've had to, basically, because we still receive a lot of posts from people. We've still been getting numerous phone calls into the office. They expect things to be normal. They expect us to be there. We can't not go into County Hall because otherwise our work would stop, because we have to get the post. We sort it, we scan it, send it out to the team, and then they have to do some work. They send it in to us, we print it and post it out again. They have coped exceptionally well considering what's happened. I've not come across any large backloads of work. Naturally, some have adjusted better than others. Some people are finding it difficult because they kind of lost touch with people, and the way the office is run is that we have them set up in teams, so they're used to talking to each other, helping each other. They are using Microsoft Teams, so it kind of does help. But I think overall, some of them would be looking to get back in the office as soon as they possibly can. But overall, I've not seen things haven't got out of control, and it's going really well considering the circumstances that we're actually working under. Certainly, we've had quite a number of pensioners contact us and thank us for being on the end of a phone and being there to help them with their issues, because they were quite concerned, thinking they weren't going to get paid, or their partner died and they weren't going to get anything else from the pension fund. So we've had a number of pensioners contact us and thank us for all the help that they've actually been given.
A question from David Harris, Mr. Chairman, please.
David. Sorry. The Oracle thing you refer to, and it's amazing that something that's cost so much money and so much more than was in the budget, so they still couldn't get right, but that's just a passing dig. Is the Oracle issue linked to the points raised by the auditors about IT systems, or is this a separate thing?
Do you want me to pick that, Russell, or are you going to pick it up?
I'll pick it up. I'll pick that one up, Calvin. No, it is different. The item that the auditors have picked up is their audit of the system that was there pre the 1st of April. It's the old Oracle on-premise system. These issues that have happened during April and May when we implemented a new system aren't what the external auditors have picked up. These are what I call teething problems that you normally get when you implement a payroll system. Unfortunately, the workload always falls on people at the sharp end, but you've got to remember that although there was 69 not paid because they were new pensioners, we still paid the majority on time. Over, I think it's 14,000.
Right, thank you. And then the other comment I would make, and I think Eddie else made the same comment, is from the sounds of it, keeping everything going and keeping everything getting paid, etc., has been a pretty incredible job. Well done.
Yeah, that's true. On the committee's behalf, David, I wrote to the team in late April saying thank you because I'd been kept in touch with the difficulties about this process. And I also saw some of the very nice comments that were made by pensioners across the county and elsewhere who were so pleased that everything managed to get sorted out in the end. So thank you again, Calvin, for your team. And again, would you please, in your next missive to them, just say the committee are grateful for all the work they've done to get this up and running so well. So thanks for that. Any other questions?
Thank you, Chairman. I'll pass it on.
Sorry, comment from Jane, just agreeing entirely with David and Derek. No more questions, Mr. Chairman.
In that case, thank you. We have on page 147 recommendation, note the update. Can someone do that, please? Chris Wilson, thank you. And Pete Mitchell seconds it. Lynn, can you take the vote, please?
Thank you, Chairman. Could those people in favour please raise your hand if you haven't already done so? Thank you. That's me. Any against? Could everybody please lower their hands? Could everybody please lower their hands? Any against? None against. Chairman, any abstentions? No abstentions shown. That motion's carried.
Thank you very much, then. Item 8, page 163, which is governance, part 1, the risk register mainly. Sean, can you deal with this, please?
Yeah, sure thing. I mean, I'll keep it quite brief. In terms of the risk register, there's been no updates to the version tabled at the previous committee meeting. Naturally, we reviewed the risk register for the implications and potentialities of COVID. However, we thought that it was captured in a number of risks which were already in the register. Those such as the geopolitical market events, impact on the value of the investments and the funding level, loss of the main office site, etc. I think the only thing that I will say which will form a part of next quarter's risk register is obviously the internal IT control issue, which was mentioned in the audit report. But that's all I really wanted to say on the risk register, unless there are any questions on it.
I haven't. Has anybody? No. By the way, welcome to Ethan.
No, Mr. Chairman, no questions.
Ethan's just joined the meeting. Welcome. Okay, so in that case, page 163, can someone propose the noting, please? Thank you, Tom. And the seconder? Thank you, Sue. Lynn?
Thank you, Chairman. Could everybody in favour please raise their hands? That's unanimous, Chairman. Thank you.
Thank you much. Could you lower your hands, please? Thank you. Okay, we're coming out of part 1 now, gentlemen and ladies, and we're going into, I haven't got any other business at section 9, so we're on to section 10. I have to read out this statement first, and then Lynn has to ask you to remove all the people standing in the background. Exclusion of the press and public. It is proposed that under section 100A brackets 4 of the Local Government Act 1972 as amended, the public be excluded from the meeting for the following item of business on the grounds that it involves the likely disclosure of exempt information as designed in paragraphs 3 of part 1 of schedule 12A of the Act, namely information relating to the financial or business affairs of any particular person, including the authority holding that information, and that proceedings apart from the resolution passed shall remain confidential. Lynn?
Could everybody, or could I have a proposer for that, please?
Yes, please. Joanna, please. Jane.
Thank you.
Or raise your hands, please, if you're in favour.
And take your hands down, and everybody in favour, please show. Thank you. It's 9 votes in favour, Chairman. That motion's carried.
Thank you very much indeed. If you can lower your hands, please.
Chairman, Sarah Goodall, meeting producer here. As you've gone into confidential session, I'll request that the live stream is switched off, and I'll confirm to you when that's happened.
Thank you, Sarah. Before we do that, before we start, it's been an hour and a half, so I'm going to have a 5-minute break. Just 5 minutes, please. Lynn, is that okay with you? Oh, Lynn, do you want to finish off your confirmation first?
That's fine. Thank you. I can do, yes, no worries. I'll now ask each of you to confirm that there's no one else present that can see or hear the proceedings. Starting with you, Councillor Holly.
No one else here, Derek Holly.
You, Councillor French.
I can declare nobody else is in.